This is a list of the 10 most common investing mistakes. Smart investors make less of these errors and more money. Who do you want to be? Many investors think that they can maximize the returns by taking large investment exposure in a single stock. And what that means is that when the market actually moves against them, they have an extremely concentrated position and can get wiped out and have disastrous long-term results on their performance. Minimizing the fees that you pay will help you maximize your wealth. There's many ways to do this, and it really depends on what sort of investments you're interested in. We'll do future videos on this exact topic, so be sure to subscribe. In general, if you're trading on your own, you want to use cheap, low-cost brokers, such as Interactive Brokers or Robinhood if you have access. We've all heard the expression, buy low, sell high. So why do so many of us make the opposite decision when it comes to investing? It comes down to fear and greed, and investors often make irrational decisions that are short-sighted and near-term focused. You need to avoid craze and fads when you're investing and focus on what really matters, getting good investments at reasonable prices. It's easy to get seduced by high dividend yields. At the end of the day, we all want to get a bit of money in our pocket every once in a while. So why wouldn't you try to maximize the money that you get back by getting the highest yield stocks? It's simple. Past returns are no indication of future performance, and the highest yields tend to carry the highest risks. You need to focus on the big picture. Don't get distracted about the rest of the company just because the stock has a good yield. It's very common when people start investing that they want to do it all the time. They trade too much and they trade too often. But when you're investing, patience is a virtue. You need to remember why you entered an investment, and you need to stay in it. Also, the frictional cost of trading too often means that commissions will eat into your profits. Over the long run, it can make a big difference on your investment returns. A common investment problem is not having a clear vision and goals set towards where you are right now and where you want to end up. And it matters. It changes the types of investments that you make. Whether you have a short-term or long-term focus, you need to make sure that you're thinking about your portfolio for the right time horizon. You need to think ahead. The loss of money, or even the gain of money, can bring up significant emotional issues that can impede your decision-making. It's important when investing to keep a level head, and one way to do this is in the event of a large move in either direction, up or down, don't make a decision right away. Always think about your decisions. Taking too much, too little, or the wrong risk is a common investing mistake. Investing involves taking some level of risk in exchange for potential reward. Taking too much risk can lead to large variations in investment performance that may be outside of your comfort zone. And taking too little risk can result in returns that are too low to achieve your financial goals. Make sure that you know your financial and emotional ability to take risks and recognize the investment risks you are taking. Trying to be a market timing genius is another common investing mistake. Market timing is possible, but it's very hard. And for people who are not extremely well trained, trying to make a well-timed call can be their undoing. For example, an investor that was out of the market during the top 10 trading days for the S&P 500 index between 1993 and 2013 would have achieved a 5.4% annualized return instead of a 9.2% by staying invested. Market timing is neglecting to start or continue investing is another common investment mistake. Individuals often fail to begin an investment program simply because they lack basic knowledge of where or how to start. Likewise, periods of inactivity are frequently the result of lethargy or discouragement over previous investment losses. You need to keep going. You need to keep doing the work, and that's how you get the returns. Don't forget to subscribe for more tips on becoming a better investor.